everybody keeps glossing it over because the company is so relatively insignificant on the JSE. EquityLine, Kalila, I think I sent you the news last week. Well, I sent you the news on a prior Friday, where the company was suspended again by the JSE and is planning to wind itself up.
Right. You did send that to me.
Yeah, so just to give some quick synopsis to the shareholders or the persons that are watching, EquityLine, from a very simple perspective, they are a company that would buy mortgages in the Canadian market. Those mortgages provide a particular amount of income. That income is used to cover expenses and pay its preference shareholders. So EquityLine would have come to the JSC back in 2018, 2019, let's say back in February 2019, got about $5 million US in capital through issuing its preference shares. The preference shares were supposed to mature January 2024. It was switched back to June 2024. They got suspended, published audited financials, got back to trading. And then on the new JSC release says that their auditor, Grant Thornton LLP in Canada, has asked to withdraw their audited report, which effectively means that the company could no longer have published audited financials on the JSC, which causes no working suspension. So with the company now being wound up, it's going to be a potentially long drawn out situation now, because preference shareholders would have been getting 16 cents US every year in dividends, maturity price of $2, so it's about 80 cents over the period. And unfortunately now the company is planning to be wound up. However, the company is in a situation of an accumulated deficit. What do I mean by that? So we all know the typical equation is assets minus liabilities equal equity. However, assets have to be greater than liabilities to have equity. In the case of EquityLine, they have $47 million Canadian in assets, but 53 million in liabilities. So they have a 5.98 million Canadian dollar deficit. And with that deficit right there, that means that somebody's, in this case, potentially preference shareholders, are going to have to bite part of the bullet in terms of, who's going to compensate it appropriately. And they're not just the Jamaican preference shareholders alone. There are also Series B and F preference shareholders based in the United States and Canada. So while those markets are a little more advanced in terms of resolving different disputes or conflicts, just the fact that you have Jamaica, US, Canada, all in this mix, there has been a legal claim brought against an affiliate of EquityLine, which is raised by the plan to wind the company up, means that this is probably going to be quite a pretty drawn out process. And the company, was actually a startup in Kalila. This company was formed back in January 2018.
They were actually what?
A startup.
A startup. Okay.
Yeah, so it's formed in January 2018. Went to the JSC by November 2018 to raise capital via preference shares. Listed in February 2019, and got suspended in June 2024, suspended again in July 2024, and now winding up. So that's to kind of give some perspective. Kalila company, would have come to the JSC capital to grow. They initially would have wanted to raise $20 million US to the issuance of 10 million Series A redeemable preference shares. They're only able to issue 2.6 million preference shares, which was just above the 2.5 million preference shares needed for the offer to have be deemed successful. And the irony is, Sagicor's managed funds, the pool funds and unit trusts, they own 1.76 million out of the 2.6 million preference shares, which is about 2/3. So they would have, saved this offer in a sense from failing back then, and now the company is winding up, and it's not like the company has any available equity to, make shareholders comfortable that, hey, something needs to be fully recovered. In this case, we don't know what potential haircut shareholders preference shareholders are going to have to face in this whole dilemma.
So, but it's not a heavily traded stock, though, is it?
It isn't. So in most cases, at that point, Sagicor's managed funds own 2/3 of the preference shares as stock, right? and the remainder that was left behind was held by what you'd call your high net worth investors. For them, just buy, collect dividends, maturity comes, take your money back, put it into another investment. So it wasn't an actively traded stock, but technically speaking, even though they got the 80 cents over the last couple of years in dividends, we don't know what is going to be the price that they're going to be paid out at when the companies want up, because they're going to be
Mm.
fees payable to a receiver. They're going to be legal fees and so forth. So by the time they actually get to paying the preference shareholders, they might probably get back a dollar on 50 cents on the dollar, which means a dollar to be repaid back to them versus the $2 they already invested.
And it just goes to show the risk involved in investing in a startup company, any startup. Those first five
In
years are
general,
difficult.
Khalil, I would not specifically just highlight as a startup company alone for risk, but any investment. So Nike One Energy Limited has taken a lot of work, local institutions and training institutions for a ride, and it's quite unfortunate because we've seen JMMB, VM Group, we've seen Republic, we've seen so many different publicly known and relatively member-owned institutions, both in Jamaica and Trinidad, that have had to do massive write-downs because of Nikeone's, current, bank. Well, I should call it. I should. What's it called again? Not bankrupt. Well, not bankrupt, but insolvent status. So these persons back in 2019, 11% US dollar yield for 1 year looked amazing, but now it looks like a foolish decision. So EquityLine is a hard reality for some high net worth persons, but if you're isolated towards just startups alone, every investment carries risk because
Right.
most people bought Nike One bonds, and most people think bonds are risk free, but Nike One still went under, and Nike One effectively, would have gotten some level of startup capital in the same time around as EquityLine. 2019, they got a good chunk of money to its operation started, had an explosion in April 2022, in April 2021, got turned off in August 2023, insolvent by May 2024. So similar situation, domestic Caribbean-based company, and as I mentioned, some of these company names already. Then you have a Proven, a Jane mutual funds or other unit trusts or managed funds that actually own Nike One investment instruments, which are now been written down. So it is going to show and a serious point that any investment can become a big winner for you, and any investment can become a massive loser for you. So the investment is risk free, even with the amount of research you might do. It's for you to really and truly just do your best to try and judge what risk exists in the market and what risk tolerance you have as an investor as well. So this is just perspective I'm just adding right now with all being said.
Wow, it's a tough situation. Very tough all around. But thank you for that perspective, David. We always appreciate you
You're welcome,
coming to
Kalila.